Hello, my name is Steve Tuttle. I'm a partner here at Signet Financial Management. I want to thank you for joining us on our call. Today I'm going to be presenting a quick review of the financial markets and then expand into our investment outlook looking forward for investors. As I pause for a moment to show our disclosures, I want to start by going back a little bit to the beginning of 2017. Going into the year, expectations were pretty low across the board. As the year progressed, however, markets definitely rewarded those investors that stayed the course and stayed invested in the markets. As the year turned out, global equity markets, both in the U.S. and overseas, posted better than expected returns. Fixed income also posted a surprisingly solid year, and all of this was produced with a very low volatility backdrop. Here's a quick chart. This is an index of a combined U.S. stock market and foreign stock markets, and as you can see, the chart for the year slopes upward in a very smooth fashion. Somewhat unique in the recent history. If you look on the lower corner over the long term, again, markets, despite some pullbacks back in 2008 specifically, the most dramatic, the market is, for the most part, over the long term, heading in the right direction, and that's up. And you can see we're still within what I would consider a fairly normal trading range for the stock market. Here's a really interesting slide that talks about volatility in 2017. And this slide specifically just highlights single days where there were significant declines. And if you look back in 2017, there were really only 2 days where the market dropped more than 1%. And that's quite unique for the stock market. And also on the yield front, if you look at the 10-year Treasury yields, again, going back into the beginning of 2017, a lot of expectations for yields to rise. But what we saw over the course of the year is basically the 10-year Treasury yield ended the year just about where it started. A little bit of volatility, but for the most part, it was just stuck in a trading range. Although you'll see from the fourth quarter 2016 into 2018, yields have been rising. They're now at the upper end of that range, and that's something that we'll be watching pretty closely looking forward. In terms of credit spreads are very low right now. This is an important indicator that we look at. Credit spreads measure the yield advantage that you receive for investing in corporate bonds compared to U.S. government bonds. And as you can see, there's not much of an advantage right now to investing in corporate bonds. The fact that credit spreads have been declining by definition means that the prices of corporate bonds have been performing pretty well. That's a good thing for investors in 2017. Looking forward, however, because those spreads are much lower right now, investors may not be getting compensated enough for taking on credit risk. So they may be a little bit vulnerable to shocks in the economy. It's something that we're watching pretty closely right now, and I thought it was relevant to bring to your attention. So where do we go from here? There's 4 main areas that we look at in terms of how we manage portfolios. Bit of a simplification, but I think it's interesting to look at these 3 areas. One, on the economic front. We are very comfortable with the global economy. We think the global expansion is going to continue. We see both in the U.S. and overseas a resilient environment of economic growth. Particularly in the U.S., we think we're probably mid to late cycle, so we don't believe the economy is ready to roll over, but we are getting a little bit late in the game. In terms of corporate earnings, fundamentals are very solid and improving, and we're expected to see a little bit more of a potential tax benefit could boost earnings in 2018 as well. In terms of interest rates, we expect the Fed to continue its gradual policy of raising rates, and that's for the most part affecting the short end of the yield curve more than any other area. Tight credit spreads, as I mentioned in that slide before, we expect that to continue. We don't think that trend is going to reverse right away, so that also is encouraging for corporate bondholders. And a flat yield curve, and by that I mean the interest rate that you receive for a 2-year bond, for example, is not much lower than what you receive for a 10-year bond. And that can present some challenges to investors as well. In terms of risks, what could go wrong? What are we focused on? Well, volatility is certainly one thing. We're in a very low volatility environment right now. We don't expect that to continue forever. And we want to warn investors against being too complacent or perhaps greedy and start to reach for higher yields, because risk is real. We will see some volatility again at some point. Valuations, they're getting a little high on the equity side. I wouldn't call them excessive at this point, but it's something that we're watching. It may be a little bit harder for stock investors to generate return as valuations continue to creep higher. Another risk that we're watching, it's not something that I believe markets are worried about presently, and that's inflation. So it's something we're watching. We're not expecting inflation to spike by any means, but that would be something that if there were an unexpected move higher in inflation, that could negatively impact markets. So it's something that we're watching. So I'll sum up in terms of positioning how we are managing our portfolios today and for the future. And there's some key themes that I think are important to point out. One, overall, it may be a time for discipline and flexibility. We've seen nice moves in the broad markets over the last 7 or 8 years, and certainly that's a good thing. But as I mentioned earlier, those returns may be harder to come by looking forward. And so to be disciplined, rebalance your portfolio, and to have some flexibility and take advantage of opportunities as they present themselves, we think will become more important looking forward. On the stock side, short markets have been rising, but our concern is that much of the good news may be reflected in prices. And that relates to valuations getting a little bit expensive. At this stage of the cycle, we think it's far too early to take profits, but we do think it's important to be well diversified. Don't overexpose yourselves into one particular area that's doing well. Have some exposure in multiple areas and have multiple sources of return working for you. U.S. stock market as a core allocation we think is still important and should benefit investors. But we also encourage you to look overseas and to consider rebalancing into foreign markets, particularly emerging markets, which we think offer attractive valuations and opportunities at these levels. On the fixed income side, I think the theme is lower for longer. Although short interest rates are rising, and in the most recent past, longer interest rates have been rising, we are not overly concerned that we're going to see the 10-year Treasury go from 2.5% to 5% anytime soon. So we do expect rates to remain fairly range-bound looking forward. Inflation may creep up. That's something we're watching. We think it's going to be gradual at this point, which will not have a negative impact on markets, but it's something we're watching pretty closely. Lower credit spreads cause us to be a little bit more cautious and selective in terms of buying corporate bonds or high yield bonds. Reaching for yield may not be as advantageous to investors at this stage in the market cycle, so that's something to be careful of. And finally, on the tax front, municipal bonds we believe are still attractive, and they offer some nice tax advantaged um, income for investors, particularly those investors in higher tax brackets. So I want to thank you for your time and continued trust. My name is Steve Tuttle. You can reach me anytime by email or phone at my office in New Jersey. I also would encourage you to follow us on Twitter at SignetFin. A lot of interesting information and market insights we post there every week. So thank you and have a good day.